Welcome to Chart Detective, where we let the charts speak for themselves. In this presentation, we'll be looking at the US 10-year Treasury, and we'll look at it by doing technical analysis. So, this is a chart for the past year, 2024, and we're looking at daily candles. This is the low for the year at 3.6%, and this is the high. It made the high earlier in April and again back in December again to January. So from September until today, it went up by 31%. And in December alone, from December to January of this year, about 14, even 15%. So 10-year Treasury has been going up, and we expect it to keep going up to 5.5, and then it should crash down after that because we think that there will be a recession that will cause it to go down. So back in December, late December, earlier this year in January, we see that a double top was made, and we have a candle pattern which we call a spanning top. So this is a signal that the trend might be reversing. And we also have a double top. Not only that, we have a bearish trend line that reached the same point as the spanning top. So we have strong indication that the trend might be getting weaker. At least we expect to see a pullback. So last Friday, January 10th, at the closing of the market, the 10-year Treasury went very high. It crossed the double top, but we still do not have confirmation yet. So we have to wait till next week when the market opens to see what happened. But our bearish sentiment, at least in the short term, will happen. We believe that there will be a pullback. So now let's look at it from 2022 until today. So we have weekly candles that we're looking at because we want to see it performing for the long term. This is the initial double top we had. We expect price to go down. The bear should step in to bring it down to this level and stop right there because we have a support line here. And the bulls will step in and move the price up to the 5% mark. Why? Because we have a resistance there. That was the previous high that was made earlier in July of 2023. And we have another strong resistance again. So it's not likely that price will move beyond this point without pulling back again. So previous resistance become support at 4.673%. So price will pull back there, and then the bulls will step back in again and move price higher. The bears may step in again to bring it lower again, and finally the bulls will bring the price all the way to 5.5%. But we don't believe this will stand. After the price went that high, we expect it to crash down all the way to 3.5%, even to 2.5 if there is a recession. So let's see how this may happen, how the 10 years treasury may go to 2.5%. So let's see this scenario here. The bear steps in, bring it down to 4%. Again, we have our support line again, preventing it to go down further from that point. Buyers steps in, but they encounter resistance. Bears bring the price, bring it down again. Stop it at 3.5%. Previous support become resistance. So we have strong resistance above 4%. So price will stop there, continue to move down again, and stop above the 3% mark because we have support there. The previous support at 3.5 become resistance. So price goes back up there again, and the bears finally will step in to drag the price down all the way to 2.5. So this is the bearish scenario for the 10-year treasury. Right, we have strong support there, so price will stop right there.